Hi, I got a question from one of the students about homework assignment problem 10-6 regarding non-monetary exchange. So I will try to explain this problem here, and hopefully you could use this information when you do your homework. This particular assignment, or actually all our assignments, is algorithmic, meaning you have the same type of question on your homework assignment, but we all have different set of numbers. So I open one problem from my side, and this is the problem probably you're looking at, but it has a different set of numbers. So your answer will be different from mine, even though I'm using this same type of question here. So when we deal with exchanges, there are a few things we have to consider. First of all, when we say we are exchanging equipment, that means I'm giving up an equipment and I'm getting a new equipment from the other party. And when the exchange will create issues. One thing is I need to get rid of all the records and evidence of my old equipment, and I have to record the new equipment at its fair value. So up here it says, the general valuation principle for the exchange is that the new equipment that you're getting is the fair value of your asset that you're giving up, plus any cash paid. If you did not pay or instead you received it, then we will reduce that fair value. So when we think about it, it actually makes sense. When we buy an equipment, we pay cash with it, right? And that's how we record the cost of the equipment. So in the same sense, when you are exchanging an equipment, then the new equipment that you are getting from the other party, that equipment's cost will be recorded at the value you're giving it up, which is equivalent to what you're paying for, right? You're giving up this valuable asset that you have, you're giving it up to get the new equipment. So therefore, it makes sense to value the new equipment at the fair value of the asset you're giving up, and plus cash you're paying for it in addition to what you're giving up. So the cost of the new equipment that you are getting from the exchange will be fair value of asset you are giving up plus additional cash you have paid. If it's the other way around, if you received cash from the other party, then we'll reduce it. It's the reverse. Okay? And then, secondly, you have to see whether the exchange had a commercial substance. If there was a commercial substance, then we would have to recognize gain or loss. If there was no commercial substance, we don't record any gain or loss, and we do not use fair value, but we use book value. But this question is dealing with the transaction that had commercial substance. So we have to record gain or loss. So how do we calculate gain or loss? Gain or loss is calculated by proceed minus book value. So proceed is the amount that you are receiving. So for example, if you're receiving $300,000 fair value, for example, and your equipment that you're giving up has a book value of 140, and how do we calculate 140 book value? It is the original cost minus accumulated depreciation. So in this case, if you had original cost of 200,000, and so far you had the accumulated depreciation of 60,000, then you would have a book value of 140, right? And for this equipment, for some reason, you had received 300,000 proceed. then you would have a gain, right? You would have a gain of 160,000. 300,000 minus 140,000 would make 160,000. So you would have a gain of 160,000. If you had, what if you had a proceed of 100,000? Lower than your book value. Then you would have a loss, right? Your proceed or the asset that you're getting had a fair value of only 100,000, but your book value had 140, then you would have a loss of 40,000. So depending on your cost and accumulated depreciation, you will have a book value determined. And then from there on, you're gonna calculate gain or loss. So let's take a look at this problem. This is your homework assignment number 4, problem 10-6. Again, I have these numbers that are different from yours, but very similar problem as you have. So in this case, there are two companies that are making exchanges. And it says down here, the exchange has commercial substance for both companies. So we should recognize any gain or loss. So let's take a look. It says this Southern company owns building that it leases to others. The building's fair value is 2.05 million and its book value is 1.32. It explains to you how they calculated this book value. It says cost was 2.65 and it had a accumulated depreciation of 1.33. So they did the calculation for you already. This cost minus accumulated depreciation would give you book value. That's good information because we need to calculate gain or loss. Now, let's take a look. What is the fair value this company received? The cost of the newly acquired equipment, or in this case, the building, is the fair value you are giving up plus any cash paid or minus the cash received. So here it says the building's fair value is 2.05. So there's a value right there, right? However, there's something about receiving cash. Southern Company received 205,000 because it says right here, down here, Eastern Company, the other party, also gives Southern Company 205,000 to complete the exchange. So what does that tell you? That tells you that the value this Southern Company is getting is actually 2.05, the fair value of its own building, minus 205,000. Because why would this company giving up $2.05 million worth of building for something less? So since the other party had a value that's less than that, this Southern Company received 205,000 from Eastern Company. So the newly acquired building should be costed at the fair value of Southern Company's building that is giving up minus cash received from the other party. So the transaction will create this type of journal entry from Southern Company's perspective. So first of all, this company received 205,000, right, from the other party. So no matter what, you know that you received cash. So 205,000 cash went up. So you will be debiting it. Then we just talked about it. The building, it just acquired from this exchange. The way we cost it is the fair value that Southern Company is giving up minus 205,000 that it received in addition to the building that it's receiving. So if you do the calculation, let's see. How much was in my example, the fair value was 2.05 million. And if you take out 205,000 from that, it will be 1.845. So that is the new cost that you will value the building this company is receiving from this exchange. So we will debit it because assets should be debited, right? At the same time, what you have to do is you have to get rid of all the records about related to old building that you're giving up. So the old building had a original cost of 2.65. How do we know that? Because it told us up here, right? It says the current building had a 2.65 original cost. So we will get rid of it. So how do we get rid of it? We get rid of it by crediting it. Because you know how we normally put on the debit side for any assets, right? So this amount must have been sitting on the debit side. But since I'm getting rid of it, I'm giving it up to the other party, we're going to credit it, so it'll be taken out from our book. And at the same time, what else we have to do? We have to get rid of accumulated depreciation. So we know there was a depreciation of 1.33 because the problem told us so. It says the current existing building had 1.33 accumulated depreciation. So since the accumulated depreciation usually sits on the right hand side, right? So since we have to get rid of it from our book, we'll put it on the other side, debit side. That way it will be offset each other and it will zero out. So by taking these two journal entries, we got rid of our old building and old accumulated depreciation. So only thing that's left to do is the gain or loss calculation. Here you could see that we have a gain of 730,000. How do we get 730,000? Well, if you take the book value from the fair value of the building you're getting, then you will get 730,000. So again, what is the fair value? Fair value is right here, 2.05. That is a fair value. So take that out. From there, you take out book value, which is 1.32. If you take book value out from this proceed, which is equivalent to fair value, you will get 730,000. If you have hard time figuring this out, well, another way of doing it is, you know how you're supposed to add up all the debit side and credit side, and they have to be equal? So what you could do is you add up all the debit side and you add up all the credit side, then you could see that the 730,000 has to go in there. Otherwise, this entry would not balance. There's another way of checking it too. So you could calculate it on your own and also make sure both debit and credit side would equal. Make sure you have an equal balance on both sides. Now let's take a look at the transaction happened from the other party's perspective, Eastern's company. Eastern's company had the building. It doesn't say what the fair value of this building was, but it just gives you 1.47 book value, which is coming from original cost of 2.25 less accumulated depreciation. And this company gave additional $205,000. So that means the building this Eastern company gave up had a lesser fair value than the building's value of the other party. Because when you make an exchange, it needs to be fair. So the other party had a fair value of 2.05. But this Eastern company had a building that had a value less than 2.05. By how much? By 205,000. That's why this company, Eastern company, must have given Southern company additional 205,000. Right? Why would these companies would make an exchange if it's unfair? So this Southern company had a building valued at 2.05. So this company would not give up that building unless it's receiving equivalent fair value. So therefore, Eastern company's building must have been 205,000 less than this building that was valued at 2.05. That is why this Eastern company must have given 205,000 to this company, right? So if you do the calculation, then 2.05 minus 205,000 will give you 1.845 million. So that must have been the fair value of the building that Eastern's company is giving up. So if you do the journal entry for Eastern's company's perspective, the new building is acquiring will be cost at the fair value that Eastern company is giving up, which is 1.845 plus $205,000 cash it gave to the other party. So it's 1.845 million plus 205,000 would make 2.050. This is the new building's cost. And what else you have to do? Well, this company gave up, paid 205,000 cash. So cash needs to be credited. And we need to get rid of all the evidence of the old building. So old building was 2.25 at its original cost. So we're gonna have to credit it. And get rid of accumulated depreciation as well. So we put it on the other side than the normal side so that it will be offset each other and it will zero out. So we get rid of depreciation, get rid of old cost of the building. And last thing we have to do is calculate the gain or loss. So again, how do we calculate gain or loss? It's the fair value that you have received or proceed you have received minus book value. So the fair value was 1.845 and the book value was 1.47. So 1.845 minus 1.47 would give you $375,000. So again, you may be wondering, how do we get to get 1.845 again? Well, going back to the original fair value of the building that Southern company gave up was 2.05. But because Eastern company's building had a lesser value, the Eastern company had to pay 205,000 to Southern company. So the exchange here, the value of the exchange must have been 1.845. So that is the fair value and proceed that Eastern company received. So 1.845 fair value proceed minus the book value, which was given to us up here. It was 1.47 million. So if you take 1.845 fair value minus 1.47 book value, you get a gain of $375,000. When you have a gain, you put it on the right-hand side because it's like revenue. You know how revenue is normal on the right-hand side? So like any gain will be on the right-hand side. If you ever get a loss from a transaction, then you put it on the debit side. Again, you should add them up, debit side and credit side. Make sure they all add up and have a same equivalent, same equal balance. Then you know you did the transaction correctly.